And it may be 5 months to Christmas, but toy makers in UK are already showing off their best, including a range of inflatable remote control vehicles, the next generation of Zuzu pets. Straight to the United States first. A small team of U.S. Treasury officials are discussing options to avoid a default if the Congress fails to raise the country's borrowing limit by the 2nd of August. Now, Treasury Secretary Timothy Geithner has already warned there is no contingency plan in place if lawmakers fail to raise the debt ceiling. But behind the scenes, Treasury officials are working to avert a financial meltdown. Now, according to Reuters agency reports, officials are studying 4 key points. First, can the administration's delay payment and manage cash flow after the 2nd of August deadline? Second, can the President Obama ignore the Congress and the government to continue to issue debt? Third, does the government legally prioritize payments? And last of all, can the U.S. Federal Reserve act as the Treasury's broker in the markets if a deal is not reached in time? Well, of course, President Obama is meeting lawmakers today on the debt issue. The talks will include top lawmakers of both the Democrats as well as the Republican Party. The negotiations are the first official sit-down since last month. We've got John Dunham, managing partner at John Dunham and Associates, joining us live from New York for a perspective on where these debt talks are headed. Thanks for joining us this morning, John. Now, after weeks of hitting a brick wall, you have Obama saying that he is aiming for something big today. What is Obama likely to propose? Reports suggest cuts in Social Security and major reductions in Medicare. Now, Obama's goal of $4 trillion in savings in 10 years is a target that we all know of. Can that be met?
Well, I think that can easily be met. Remember, this is $4 trillion off of expected spending, so it's not actually a real cut in nominal spending that they're even talking about right now. I think that the president has a history of not really proposing big things, but reacting to things that Congress is proposing. So I don't think you're going to see a whole lot coming out of this other than what you've already heard. Some minor cuts in Medicare and Medicaid. These are not big cuts that they're talking about. They're going to continue to push for tax increases on what they call the rich, and they're going to continue to push for changes in the tax code, which isn't a bad idea, but I'm not sure how the Republican Congress is going to react to that.
Right, John, but it's interesting that the Treasury is quietly coming up with a plan to avert a default in America behind the scenes. What signals does this really send out about a long-term debt deal actually being sealed then?
Well, I mean, that's 2 questions really. The long-term debt is a real big problem. The federal, not only the federal government is got a huge debt problem, but also the state governments in America, including some of the biggest states, have a huge problem that probably the federal government will end up picking up. That said, I have a very good friend that's an appointee at Treasury, and he will tell you, and everyone will tell you, there's some very, very good people working at Treasury. The professional staff there is excellent, and they're working on contingencies all the time. I don't think that the August 2nd date is really a hard deadline at all. I think they probably got a good month of wiggle room in there before they even have to do anything draconian.
John Dunham, many thanks for joining us with your views there on the debt talks, of course, that are in focus, and that will revive today as U.S. President Barack Obama meets top congressional leaders. Meanwhile, Obama took to Twitter yesterday to press his economic agenda, using the popular social media site to tweak Republicans and advocate for a deal to reduce the country's deficit. Now, in a town hall-style meeting that lasted about an hour, the president fielded questions posted by users of the Twitter site and sent his first live tweet from a laptop in the White House East Room, making what he called presidential history. Speaking on the U.S. debt, Obama said the debt ceiling should not be something that is used as a gun against the heads of the American people to extract tax breaks for corporate jet owners.
What's happening now is that Congress is suggesting we may not vote to raise the debt ceiling. If we do not, then the Treasury will run out of money. It will not be able to pay the bills that are owing, and potentially the entire world capital markets could decide, you know what, the full faith and credit of the United States doesn't mean anything. And so our credit could be downgraded, interest rates could go drastically up, and it could cause a whole new spiral into a second recession. Never in our history has the United States defaulted on its debt. The debt ceiling should not be something that is used as a gun against the heads of the American people to extract tax breaks for corporate jet owners.
Okay, that's Obama on the debt situation in the United States. Meanwhile, Wall Street, of course, is off to a strong start this morning. The Dow Jones up 0.5% and the S&P gaining more steam, up about 0.75% in trade. Let's go across to Karina Huber live from New York for a sense of what's playing out on sentiment. Hey, Karina, let's begin with data. Most of it, of course, from the jobs market. You've got jobless claims as well as the ADP report out there. Any signs of recovery on the employment front?
Shivani, in a word, yes. We had very good numbers today, and that's why Wall Street is rallying. Let's start with the least interesting of the data, the weekly jobless claims. We see that they rose to 418,000. That's a drop of 10K from a week prior. So this is good news. It is a beat. On the negative, though, it is still above that psychologically important 400K mark. Only when we see a number below that amount do we see signs of a healthy labor market. But still, a beat on that number. Let's get to the ADP report, which is really the exciting stuff today. That's a read on private sector hiring. We were expecting to see a jump of 68,000 jobs last month. What we got was 157,000, so much higher than expected. And it's really the small businesses, so companies with 50 employees or less, that represented the bulk of the hiring. And when it comes to sector, the services sector saw the biggest jump, but also encouraging, we saw that factory jobs, which were cut in May, increased in June, so a bit of a rebound there. That supports also the latest data that we've got on manufacturing. Now, what does this mean? It means that in the spring we saw a cool down in the labor market. Seems like things are picking up this summer. Bodes well for the second half of this year. And then tomorrow, of course, we got the big jobs report from the government. Things are probably going to be revised upwards. We're expecting now about 90,000 jobs created last month, but the unemployment rate will likely remain unchanged at 9.1%.
Right, Karina, thanks for breaking that down. Clearly, the jobs market cheering Wall Street today. Let's focus on the consumption data point as well. Many retailers seem to have outpaced Wall Street estimates for monthly sales in June. How good are those chain store numbers?
Those numbers are also very exceptional today, so we've had a win on 3 counts today. We saw that overall sales were up 6.5% in June. What was expected was a bump of 4.9%. 87% of the retailers at Thomson Reuters surveyed beat expectations. So we saw that consumers were attracted to the stores by some of those discounts. We also, the teen retailer was back. This is a good sign because there had been some pressure for teen retail. In fact, it was the second best performing among the retailers. Top, of course, was the discounters. And we saw that June was helped by the July 4th holiday as well as Father's Day. This bodes well as well for the back-to-school season, which is the second busiest shopping season of the year. So very good numbers today.
Great, Karina. Thanks for that. And good going there on Wall Street, gaining over 0.5% in trade right now. Shifting focus to Europe, where the European Central Bank raised interest rates by 25 basis points to address above-target inflation in the Eurozone. Now, the benchmark interest rates in the Euro now stand at 1.5%. The second round of monetary tightening comes despite the intensifying debt crisis in Greece. Let's run you through a quick check on how Europe is shaping up. You've got the FTSE, CAC, DAC, all turning in the green, up about 0.5%, 1% there on the FTSE. Good going for the CAC and the DAX as well, all gaining steam. Interesting to also look at what the markets in Greece and Portugal are up to. Of course, the IMF has cleared that €12 billion emergency funding for Greece, but you do have ratings agencies saying that there could be a selective default. Greece is down about 0.5% in trade. Portugal, though, is higher by 2%. Let's in fact go across and get you a view now from ECB President Jean-Claude Trichet. He has ruled out a selective